Latest thoughts, real estate services, so Redfin and Realogy.
So Redfin we have on as the best idea short. I guess the two incrementals there, one is they had a huge IPO lockup expiration in late January. And since then, insiders have not been shy about selling out of their positions. So we've seen material sales from the CFO, the head of technology, the head of growth, the head of real estate operations. Also, there are large blocks of stock at Redfin owned by the original venture investors. One of them, Greylock Partners, which owned 8 million shares at the time of the IPO, has sold out of about a quarter of their stake. They've sold roughly 2 million shares. And the thing to think about is that over the next couple of years, I would expect to see a lot more of that sort of heavyweight selling because, a lot of these venture investors have sort of a timeline that they're really operating under. And they've been invested now for several years in Redfin already. So they're sort of beginning to get towards the end of that permissible sort of hold period, and they own a lot of stock. So I think that's going to be a problem. In the shorter term, we showed that chart earlier where Redfin's demand index showed sort of just a nosedive down in February. And we looked at the year-to-date in that demand index relative to the fourth quarter, and it's down 10%. And if you went back and looked at the comparable year-to-date, the January-February data from 2017, and compared that to the fourth quarter of 2016, it was up 10%. Yep. So basically, year-to-date this time last year, they were tracking up 10%. Now they're tracking down 10%. So I don't think it bodes very well for this quarter. Again, I think the bigger picture backdrop with Redfin is that the top line growth is slowing. There is not the sort of operating leverage that I think people sort of think and are still pricing into the stock. So that's sort of the update there. On Realogy, we were long Realogy beginning early last year and running up basically through the fall. Largely, I think that call played out well because you were sort of in this environment where you were basically comping very easy comps in the high end that had become a very favorable setup. Realogy is very exposed to the high end. And that sort of played out really over sort of the 1Q, 2Q, 3Q 2017 timeframe, basically right up until you hit this sort of tax legislation. So they rolled out all these SALT provisions that were very detrimental to markets that are core to Realogy's owned business, their NRT business. And it was at that time that we pulled the plug on the idea on the long side. And the stock's basically been struggling since. Yep. As we sort of laid out, the outlook for Manhattan through the bulk of the rest of the year is not good. The outlook for luxury is not good. These are all sort of, in Realogy's sort of the heart of their operating environment. So at least for the intermediate term, I don't think Realogy is certainly not compelling on the long side. But maybe as we sort of get into later 2018, it might sort of re-present itself as an opportunity to, potentially once again sort of comp that easier comp.